Welcome back, everyone. Ready to dive deep again.
You bet.
This time, we're tackling a topic that's both fascinating and, well, kind of intimidating. Equity valuation.
It can be a bit of a head scratcher, that's for sure.
It's all about trying to figure out what stocks are really worth. And trust me, it's way more complex than just checking the price ticker.
Yeah, it's definitely not that simple.
We're going to be dissecting some seriously thought-provoking excerpts from a CFA Institute Research Foundation monograph.
Oh, yeah. This monograph is packed with insights from some of the brightest minds in finance.
We've got academics, industry veterans,
Yeah.
a real brain trust weighing in on this whole tricky business evaluation.
It's like a masterclass in equity valuation, all distilled into this one document.
So get ready, because we're going to tackle the big questions. Like, is there even such a thing as a stock's true value, or is it all just, relative?
That's the million-dollar question.
How do those so-called experts even try to calculate value? And can we really trust their fancy models?
Well, we'll get into the nitty-gritty of those models, both their strengths and their limitations.
We're also going to unravel how things like market sentiment, those gut feelings and herd mentality moments and stuff, like central bank policies, impact stock prices.
Oh, and those can have a huge impact, that's for sure.
Oh, and we can't forget the elephant in the room. Are these new technologies, like AI, about to totally rewrite the entire valuation playbook?
Now, that's a question that keeps a lot of people up at night, yeah.
Buckle up, it's going to be a wild ride. But first, let's lay the foundation. When we talk about a stock's intrinsic value, what are we really talking about?
It sounds kind of mystical, right? Like something out of a fantasy novel.
Yeah, a little bit.
Well, in a way, it is a kind of holy grail for investors.
Explain that.
Think of intrinsic value as the bedrock worth of a stock, stripped of all the market noise, all the hype, and speculation.
Ah, so it's like trying to filter out all the distractions and get to the core of what a company's actually worth.
Exactly. Intrinsic value is all about what a stock should be worth, based purely on its underlying fundamentals.
Okay, so we're talking about its earnings, its assets, its growth potential, all that good stuff.
You got it. But, and here's the tricky part, financial theory tells us a stock's price should reflect all its future benefits. Future dividends, potential price appreciation, the whole 9 yards.
Nonsense.
But those future cash flows, well, they're inherently uncertain.
Yeah, like trying to predict the weather 6 months out.
It's exactly like that. Too many variables, too much that can change.
Right. And we all know the market doesn't always behave rationally. I mean, haven't we all seen stocks just skyrocket based on pure hype? It's like sometimes it's emotions driving the price, not logic.
Oh, yeah. That happens more often than you might think.
So in this whole quest for intrinsic value, it sounds like we're trying to pinpoint a moving target.
You hit the nail on the head. Professor Ficardi, one of the contributors to the monograph, put it perfectly. Intrinsic value is one of the most important and elusive constructs in investment theory and practice.
It's like we're all chasing this elusive unicorn, trying to capture this thing that might not even truly exist.
Well, it exists in theory, but pinning it down in the real world, that's the challenge.
And that brings us to the fascinating world of valuation models. These are the tools that the experts use.
Right. They're the frameworks they use to make sense of all this complexity. But it's not like there's one magic formula.
So walk us through the main approaches. Are there different schools of thought here?
Absolutely. You've got your two main camps when it comes to valuation. Absolute and relative.
Sounds like a philosophical debate.
Well, in a way it is. Absolute valuation tries to figure out that intrinsic value directly, like straight from the company's fundamentals.
So it's about dissecting a company, really understanding its DNA to figure out what it's truly worth, even if the market's going crazy.
Exactly. No shortcuts here. You're digging into those financial statements, analyzing the management team, understanding the competitive landscape.
Got it. So within this absolute valuation world, what are the main models people use?
You've got your workhorse models, the dividend discount model, DDM, and the discounted cash flow model, DCF.
Ah, those acronyms. They sound pretty intimidating.
They can be a mouthful, but the concepts behind them are actually pretty straightforward.
Break them down for us. What's the basic idea behind each one?
Okay, so the DDM, it basically says that a company's worth is the present value of all its future dividends.
So if a company pays out a lot of cash to shareholders, it's worth more.
Yeah, that's the basic premise. But of course, there's a lot more nuance to it. We have to consider things like the growth rate of those dividends, the riskiness of the company, and so on.
And dividends can be so unpredictable, right? Companies can cut them if times get tough.
That's true, which is why the DDM isn't always the most reliable model.
So what about the DCF? How is that different?
The DCF focuses on free cash flow.
Free cash flow.
It's the cash a company has left over after paying for its operating expenses and any investments it needs to make. It's considered a more fundamental measure of a company's financial health.
So less susceptible to those dividend shenanigans.
Exactly. It's harder for companies to manipulate free cash flow, so many analysts see it as a more objective measure.
Okay, I'm starting to see the appeal of that. But even with free cash flow, aren't we still making a lot of assumptions about the future?
You're absolutely right, and that's one of the biggest challenges with any valuation model, whether it's DDM, DCF, or anything else.
Yeah, like how much will a company earn in 5 years, 10 years? It's crystal ball gazing to a certain extent.
It is, and then you have to figure out what discount rate to use, which is basically the rate of return you'd expect to earn on a similar investment.
Okay, so there's a lot of guesswork involved.
Hmm.
And that's just with the DDM and DCF, right?
Mm-hmm.
What about relative valuation? How does that approach things differently?
Relative valuation takes a different tack. Instead of trying to determine intrinsic worth directly, it compares the company to its peers using market multiples.
I've heard of that. So it's like saying, okay, this company is similar to these other companies, so its stock price should be in a similar ballpark.
Exactly. You're using those classic ratios like price to earnings, PE, price to book, PB, things like that. The idea is companies in the same industry with similar growth prospects and risk profiles should be trading at comparable multiples.
But wouldn't that depend on those other companies being accurately valued in the first place? What if the whole industry is overvalued? Like what happened with like the tech bubble back in the 90s?
Yeah, you've hit on one of the biggest limitations of relative valuation. It's very sensitive to market sentiment, to those overall market valuations.
So it can be misleading if the market itself is out of whack.
That's right. It's crucial to understand the context. You need to consider the overall market environment, not just blindly apply these multiples.
It sounds like there's a lot of room for interpretation, a lot of potential pitfalls with both absolute and relative valuation. So are these models ever really accurate? Do they have any predictive power when it comes to, future stock returns?
That's the ultimate question, isn't it? Can these models actually help us make money?
Well, that's what we're all hoping for, right?
Right. But the research on the predictive power of valuation models is, well, it's mixed. Some studies show certain models, like the CPE ratio, that cyclically adjusted PE ratio, they have some predictive ability over longer time periods.
But not always.
The signals aren't always clear. And even if a model says a stock is totally mispriced, it doesn't guarantee the market will correct that anytime soon.
So even if we find a stock that looks cheap, according to our model, it might stay cheap for a long time.
It happens all the time. The market can be irrational for surprisingly long periods.
Which brings us to those dreaded value traps.
Ah, yes. The stocks that look like a bargain but are actually, they're cheap for a reason.
Like there's something fundamentally wrong with the business, even if the numbers look good on the surface.
Exactly. And that's why valuation models, while they're useful, are just one piece of the puzzle.
So we need more than just a fancy spreadsheet to make good investment decisions.
Absolutely. You need a deep understanding of the business itself, the industry, the overall market environment. And you got to be aware of the limitations of those models and the fact that we're all human, prone to biases and errors.
Speaking of human error, let's talk about market sentiment. Those emotions, biases, that herd mentality we all know, they can sometimes drive prices far away from those fundamental values we were discussing.
Oh, for sure. That's why investing is more than just crunching numbers. It's also about understanding psychology.
Are there any classic examples of this phenomenon where market sentiment just took over and drove prices crazy?
Oh, there are tons. Remember the dot-com bubble in the late 90s? So many companies with no earnings, no proven business models, their stock prices were through the roof simply because of hype and speculation.
It's amazing how powerful those intangible factors can be. So we've covered the basics of valuation models and acknowledged that human emotions can really throw things off. But what happens when those models themselves just break down? Are there situations where those traditional valuation techniques just don't cut it?
Oh, definitely. There are certain types of equities that are notoriously difficult to value, and that's when things get really interesting.
Okay, I'm intrigued. Let's dive into those tricky cases. What are we talking about here? Give us the rundown.
We're talking about IPOs, those initial public offerings in private companies. These are the areas where traditional valuation methods often need some serious adjustments, some creative thinking.
Why are IPOs so hard to value? I mean, they usually generate a ton of buzz and excitement, so you'd think it'd be easy to figure out what they're worth.
Well, the problem is you often have very limited financial history to work with. These companies are often young, haven't been publicly traded before, so there's no track record to analyze.
Ah, so it's like trying to value a racehorse based on just its pedigree and a couple of practice runs.
That's a great analogy. You see the potential, but there's a lot of uncertainty too. Plus, IPOs are often surrounded by, well, hype.
Right, a lot of speculation, especially in those hot sectors.
Exactly. And that can make it really hard to separate the signal from the noise, to determine what's a legitimate valuation and what's just pure hype.
And let's not forget the analysts. They don't always help, do they?
Oh, they can definitely get caught up in the excitement too. Those investment banks underwriting the IPO, they have a vested interest in seeing the price go up. So their research might not always be the most objective.
So it's like a self-fulfilling prophecy. The hype builds, the analysts jump on board, and the valuation keeps climbing, even if it's detached from reality. But how do they even approach valuing these young companies when those traditional metrics, like PE ratios, might not even apply?
That's where things get creative. Sometimes analysts have to use non-financial multiples.
Non-financial, what does that even mean?
It means they're looking at things like website hits, number of subscribers, app downloads metrics that capture the company's growth potential, even if they don't translate directly into profits yet.
Okay, but isn't that incredibly risky? What if those users never actually become paying customers? Or the company can't figure out a way to make money from all those eyeballs?
You're right, it is risky. There's no guarantee that user growth will translate into financial success. And that's why valuations based solely on these non-financial metrics can be very misleading.
So it's back to that art versus science thing. Valuation is never just about plugging numbers into a formula.
Especially when it comes to these hard-to-value companies. Okay, ready for the other tricky case?
Do you love it?
Private companies.
So companies that aren't listed on a stock exchange, why are they so difficult to value?
The biggest difference is transparency. With public companies, we have a ton of information. Financial statements, regulatory filings, analyst reports.
Right, it's all out there in the open.
But with private companies, that information is often closely guarded, confidential.
It's like trying to value a company shrouded in secrecy.
Exactly. And that makes it a lot harder to assess the fundamentals, to really understand what's driving the business.
So how do you even begin to value a private company when you're working with limited information? What are the tricks of the trade?
Well, sometimes we have to rely on what we call rule of thumb methods, like looking at the price of recent transactions involving similar private companies.
So basically seeing what other people have paid for comparable businesses.
Yeah, that's the idea. But even that can be tricky. Those transactions might not be directly comparable.
Like the terms of the deal could be different. The motivations of the buyers and sellers could be different.
Exactly. You have to understand the context, not just blindly apply a multiple from one deal to another.
It sounds like valuing private companies is more like detective work than, pure financial analysis.
It is. You have to gather clues, piece together the puzzle, and make your best judgment based on the available information.
Okay, so we tackled valuation models, the challenges of IPOs and private companies. But what about the bigger forces that can distort the entire market, making it even harder to figure out if stocks are fairly valued?
Yeah, those market-wide distortions can throw a real wrench in the whole process.
I'm thinking about things like central bank policies, corporate buybacks, all those things that can create bubbles and distort prices.
Yeah.
How do they fit into the picture?
They're a huge part of the equation. Let's start with central bank policies. We've had these historically low interest rates and all that quantitative easing for over a decade now.
Yeah, easy money, as they say.
It's definitely had an impact on asset prices, pushing them higher, and that includes stocks.
Right. When interest rates are super low, investors are hungry for yield, so they're willing to pay more for stocks, even if those valuations seem stretched.
That's exactly what's been happening. But the question is, what happens when those rates eventually rise?
Yeah, that's the big fear, right? What happens to those inflated asset prices when the party's over?
Well, there's a lot of debate about that. Some economists are worried that this whole thing could lead to a big asset price correction.
Like a bubble that bursts.
Potentially. And even Warren Buffett, the oracle of Omaha himself, has expressed concern about the potential for a market bubble in this environment.
So even the wisest investors are scratching their heads a bit.
It's a very unusual situation, historically speaking. We've never had interest rates this low for this long, so it's uncharted territory in a lot of ways.
Okay, so we've got central banks pumping money into the system, potentially inflating asset prices. What about corporate buybacks? How do those distort the market?
Well, when companies buy back their own shares, they reduce the supply of stock in the market.
Basic supply and demand, right?
Yeah.
Less supply, higher prices.
Exactly. And we're not talking small numbers here. Companies have been spending trillions of dollars on buybacks in recent years. It's been a massive trend.
Yeah, I've seen the headlines. But are buybacks supposed to be good for shareholders? I mean, they increase earnings per share, they boost returns, right?
They can, but there's a growing concern that some companies are using buybacks to manipulate their earnings per share rather than for genuine value creation.
Ah, so it's more about making the numbers look good than actually improving the business.
Sometimes, yes. And that's a problem because it creates a false sense of growth, a disconnect between the stock price and the underlying fundamentals of the business.
So it's another factor that can make it really hard to determine if the market is truly reflecting fair value.
Okay, so we've got central banks pumping liquidity into the system, companies buying back their own shares, and investors chasing yield in this low interest rate environment. It all sounds a bit like a recipe for well, for a bubble.
It's certainly a cause for concern. All these factors combined create a very complex and, frankly, distorted market environment.
And where does that Buffett indicator fit into all of this? I remember you mentioned it earlier. Can you remind us what that is and what it's telling us right now?
The Buffett indicator, also called the market cap to GDP ratio, it's a pretty simple but powerful metric that Warren Buffett himself has said is probably the best single measure of where valuations stand at any given time.
And what's it saying right now? It's flashing a warning signal. It's currently way above its historical average, which suggests that the market might be, well, overheated.
Oh boy. If even Warren Buffett's worried, it's probably a good idea to pay attention. But are there any other, metrics or indicators we can look at to get a sense of whether the market is overvalued or undervalued?
There are a ton of valuation metrics out there. Everything from the classic PE ratio to more complex measures like the Shiller PE, also called the KP ratio.
Yeah.
And of course, we can't forget about good old-fashioned economic analysis.
Right, looking at things like GDP growth, corporate earnings, interest rates, inflation, all those things that tell us about the overall health of the economy.
Exactly. It's all about piecing together the puzzle, considering multiple perspectives to get the most complete picture possible.
It sounds like there's no single magic bullet, no easy answer to this whole valuation question.
That's right. And that's what makes it so challenging, but also so intellectually stimulating.
Okay, we've covered a lot of ground, but we can't wrap up this discussion without talking about the elephant in the room: technology. How are big data, machine learning, AI, all those buzzwords actually transforming the world of equity valuation?
That's a great question. And it's a topic that's generating a lot of excitement and a little bit of anxiety, I'd say, in the investment world. It's a whole new frontier, and we're just starting to explore its potential.
Okay, I'm ready for the next leg of this journey. Let's dive into the tech-driven future of equity valuation.
Let's do it.
Okay, ready to explore how tech is shaking up equity valuation.
Absolutely. It's a fascinating time to be in this field, that's for sure.
So is this like the end of traditional fundamental analysis as we know it?
Yeah.
Are those Wall Street analysts about to be replaced by robots?
Well, that's the million-dollar question, isn't it? Some people definitely think so. Like, they see these technologies as this unstoppable force that's going to automate everything.
Yeah, I could see that. But others think that human judgment will always be crucial, right?
Right. They argue that no matter how smart the algorithms get, there's always going to be a need for human intuition, for that ability to see the bigger picture, to connect the dots in a way that machines just can't.
Okay, so before we get too deep into that debate, let's break down these technologies one by one. Let's start with big data. What's the big deal, and how is it being used in equity valuation?
Well, the big in big data refers to the sheer volume, the velocity, the variety of information that's available now. We're talking about massive data sets that go way beyond those traditional financial statements, like social media posts, satellite images, credit card transactions, website traffic data. I mean, you can get data from sensors embedded in all sorts of devices.
Wow, that is a lot of data. But how do we make sense of it all? It's like trying to drink from a fire hose.
Right. It's overwhelming. And that's where machine learning and AI come in. These technologies are designed to sift through these huge data sets and find those hidden patterns and relationships that humans might never even see.
Okay, so instead of relying solely on financial statements, we can now analyze the company's performance from all sorts of angles.
Exactly. For example, hedge funds are using satellite images to track the number of cars in a retailer's parking lot. They're using that as a proxy for foot traffic to get a sense of how the business is doing.
That's wild.
Yeah.
So it's like getting real-time intel on a company's operations without even stepping foot in the store.
Pretty much. Or imagine analyzing social media sentiment to gauge how consumers feel about a particular brand or product. You can track that over time, see how it changes in response to marketing campaigns or product launches.
Okay, that's starting to paint a picture of how powerful this stuff can be. But aren't there, ethical concerns with all this tracking and analysis?
Oh, absolutely. As these technologies get more sophisticated, we have to be really careful about how we use them. Privacy, data security, algorithmic bias, these are all huge issues that we need to address.
Okay, so big data provides the raw material, and machine learning and AI help us make sense of it. But how are these technologies being applied in actual investment strategies? Like, give us some concrete examples of how this is playing out.
Sure. One really exciting application is sentiment analysis. Hedge funds and asset managers are using natural language processing, that's NLP, a branch of AI, to analyze things like news articles, social media posts, earnings call transcripts. They're trying to gauge market sentiment, see how people are feeling about a particular company or industry.
So instead of reading hundreds of articles or scrolling through endless tweets, an algorithm can do the heavy lifting, right?
Exactly. And it can do it with a level of detail and speed that humans just can't match. These algorithms aren't just counting keywords, they're analyzing context, identifying patterns in language use, even assessing the credibility of the source. It's super sophisticated stuff.
It's like having a team of super analysts working 24/7, constantly monitoring every bit of information that could impact a company's value. What other applications are we seeing out there?
Another really promising area is nowcasting. Imagine having access to real-time economic data, a constant stream of information telling you exactly how the economy is doing right now.
That sounds pretty amazing.
Yeah.
But how is that even possible?
By analyzing a huge variety of data sources, things like online prices, shipping data, social media conversations about jobs and spending, algorithms can estimate economic indicators like GDP growth, inflation, unemployment with a lot more speed and accuracy than those traditional methods that rely on government reports.
So instead of waiting months for a government report that might be outdated by the time it comes out, you can get a much more up-to-date, dynamic picture of the economy.
Exactly. And that's super valuable for investors who are trying to make decisions in this fast-paced market.
Okay, so we've got sentiment analysis, nowcasting. What else is out there?
Oh, tons of stuff. AI is being used to identify mispriced stocks, to forecast corporate earnings, even to predict the risk of a company defaulting on its debt.
Wow, it sounds like AI is basically taking over every aspect of investing. But what about the limitations? What are the potential downsides of all this?
That's the key question. One of the biggest challenges is data quality. If the data you feed into these algorithms is inaccurate, incomplete, biased mass store, the results are going to be garbage. No matter how sophisticated the algorithm is, it can't fix bad data.
So, garbage in, garbage out, as they say. But what about the algorithms themselves? Are there any inherent biases or limitations in how they process information?
Oh, for sure. One of the biggest challenges is something called overfitting.
Overfitting, what's that?
It's when you train an algorithm too closely to the historical data to the point that it becomes really good at predicting the past, but it fails to generalize to new situations. Like, think of a student who memorizes the answers to last year's exam, but can't actually apply the concepts to a new set of questions.
So you could end up with models that are great at predicting the past, but terrible at predicting the future.
Exactly. And that's a big problem for investors, obviously.
Okay, so it sounds like there's a real need for human expertise here to make sure that these algorithms are being used correctly, that the data is good, and that the models aren't just chasing ghosts of the past.
Absolutely. We need people who understand both the technology and the financial markets, who can spot those red flags and make sure we're not getting fooled by our own cleverness.
Okay, so even in this age of AI, human judgment still plays a vital role. We're not quite ready for the robot overlords to take over Wall Street.
Not just yet. I think the most powerful approach is going to be a collaborative one, where humans and machines work together, each leveraging their strengths.
It's like a partnership where AI can handle those massive data crunching tasks, freeing up humans to focus on the things they're really good at. Strategic thinking, creative problem solving, that kind of stuff.
Exactly. That's where I think the real magic happens, at that intersection of human ingenuity and technological power.
Okay, so maybe it's not about robots replacing humans, but rather augmenting our capabilities, giving us new tools to understand the world and make better decisions. But this raises a whole bunch of other questions, right?
Oh, yeah, for sure. Like, how do we ensure that these technologies are used ethically and responsibly? How do we educate investors, both individual and institutional, to navigate this rapidly changing landscape? And what are the long-term implications for the markets as these technologies become more widespread?
Big questions. But before we dive into those, let's circle back to that age-old debate, active versus passive investing. Does all this technology change the equation? Is there a clear winner in this new data-driven world? Or is the future more about finding the right balance?
Those are great questions, and they're questions that are top of mind for a lot of investors right now.
Welcome back to the deep dive. We've explored those traditional ways of figuring out what a stock is worth. We've even tackled those tricky cases that make even the pros scratch their heads. And we've journeyed into this mind-blowing world where big data and AI are changing the investing game as we speak. But now let's bring it all home. How does this impact you, the individual investor, trying to make sense of it all and make smart choices with your hard-earned money?
That's the key question, isn't it? We can geek out on fancy models and cutting-edge tech all day, but at the end of the day, it's about making those informed decisions that help you reach your financial goals.
Exactly. And one of the biggest decisions investors face is this whole active versus passive debate. Do you try to beat the market with carefully chosen stocks, or do you just ride the wave with index funds? It's a question that's been around forever, but it feels like all this new technology is just adding fuel to that fire.
It definitely is. On the one hand, you have this massive rise of passive investing, with index funds and ETFs becoming super popular, especially with younger investors. They're low cost, easy to manage, and often deliver pretty solid returns over the long haul.
Right, we've all seen those SPIVA scorecards, and they don't paint a very pretty picture for a lot of those active managers. Majority of them just can't seem to beat their benchmarks, especially over those longer time periods.
It's true, but then you have this whole explosion of data and AI, which is giving those active managers a whole new arsenal of tools to potentially gain an edge.
Well, it's like a technological arms race with both sides trying to outsmart each other. Where does that leave the average investor? Is there like a clear winner in this battle of active versus passive?
I wish there was a simple answer, but there's not. It really depends on your individual situation,
Yeah.
your risk tolerance, what you're hoping to achieve with your investments, and how much time and effort you're willing to put into managing your portfolio.
Okay, so no one-size-fits-all solution, but let's break it down a bit. What are the main arguments in favor of passive investing in this new world order we're living in?
Well, the biggest argument for passive has always been its simplicity and low cost. You're basically buying the whole market or a specific slice of it through an index fund or ETF. You get broad diversification, which helps reduce your risk, and you're not paying those high fees to active managers who may or may not actually beat the market.
Right, and as you said, those SPIVA scorecards show that a lot of active managers struggle to outperform those benchmarks. So passive seems like a pretty safe bet for a lot of people.
It is for many, but then you have this interesting dynamic where the popularity of passive investing itself might actually be creating opportunities for those skilled active managers.
How so? I thought passive investing was supposed to make the market more efficient.
That's the idea. But as more and more money flows into these index funds, they become less sensitive to changes in individual stock prices. Think about it. They're just buying and holding a basket of stocks based on that predetermined index, regardless of whether those individual stocks are overvalued or undervalued.
So even if a stock is mispriced, it might not actually be reflected in the index because those passive funds are just buying and holding no matter what.
Exactly. And that's where those really skilled active managers might be able to spot those mispricings, exploit them, and generate alpha. That's the return above and beyond what the market delivers.
Intriguing. So maybe passive investing inadvertently creates a playground for those savvy active managers.
It's possible, but it definitely raises the bar for what it takes to be a successful active manager these days. You can't just rely on gut feeling or a network of buddies anymore. You need access to those sophisticated data analysis tools, a deep understanding of market dynamics, and the ability to uncover insights that aren't already baked into the price.
So it's like a survival of the fittest situation. Only the most skilled and adaptable active managers will thrive in this environment.
That's a good way to put it. The competition is fierce and the margin for error is getting smaller. But for those who can rise to the challenge, there's still potential for those big rewards.
Okay, so there's still a role for active management, but it's becoming more specialized, more demanding. But let's bring it back to the individual investor. If there's no easy answer to this active versus passive debate, how do we navigate this complex landscape? What are the key things to keep in mind?
First and foremost, you need to really understand your own financial picture, your goals, your risk tolerance, how long you plan to invest. There's no one-size-fits-all approach. What works for one person might be a disaster for another.
Right, it's about aligning your investment strategy with your own unique circumstances, your personal financial objectives.
And in this world of information overload, it's more crucial than ever to be financially literate, to really understand the basics of investing, the different types of assets, the risks and rewards that come with each and those different investment strategies.
So we can't just blindly follow those hot stock tips from our friends on social media.
Definitely not. Investing is not a game of chance. It's a discipline that requires knowledge, patience, and a willingness to do your homework.
And speaking of homework, what about all this new technology we've been discussing? How can individual investors use these tools to make smarter decisions?
That's a great question. And the good news is there's a growing number of platforms and tools out there that can help you access and analyze data, track your portfolio, even automate certain parts of your investment strategy.
So it's like having a personal financial advisor powered by AI.
In some ways, yes, but it's important to remember that these tools are just the tools. You still need to understand how to use them effectively, and you need to be aware of their limitations.
So it's not about blindly trusting the algorithms or trying to game the system with some secret formula.
Exactly. Technology can be a powerful ally, but it can't replace sound judgment and a well-thought-out investment plan.
It sounds like the key takeaway here is that whether you choose active or passive, whether you embrace the latest tech or stick with more traditional approaches, the foundation of successful investing is knowledge, discipline, and a willingness to adapt to this constantly changing world.
I couldn't have said it better myself.
Well,
The world of investing is more complex and dynamic than ever before, but those core principles of sound investing, they remain timeless. Diversify your portfolio, manage your risk, invest for the long haul, and never stop learning.
well said. I think we've covered a ton of ground today, from those theoretical foundations of equity valuation to the very real challenges of investing in this rapidly changing world.
It's been a fascinating journey, and I hope our listeners have gained some valuable knowledge and insights along the way.
I know I have, and I want to thank you, our expert, for sharing your expertise with us today.
It's been my pleasure.
And to our listeners, thank you for joining us on this deep dive into the world of equity valuation. We encourage you to continue exploring this topic, to delve deeper into that CFA Institute Research Foundation monograph we mentioned, and to never stop learning.
Remember, the world of investing is constantly evolving, but those fundamental principles, those remain timeless.
So until next time, keep diving deep, fellow learners.